Okay, good morning, everyone. I'm very pleased to be with you today for this discussion, this webinar on EU capital markets, EU Listing Act, but also beyond. My name is Veit Jonathan. I will be your moderator today. I will be moderating this very interesting webinar. I work as a policy manager at EPRA within the Public Affairs Department, and my main focus areas are financial and tax files, such as the one that will keep us busy today. Today's topic, the EU Listing Act, was one of the big initiatives under the Capital Markets Action Plan under the previous Commission, and the objective was to make the EU capital markets more accessible, more attractive, and more competitive, especially for small and mid-sized companies, not only. Indeed, and you heard about it many times, when it comes to get listed, a lot of European companies seek listing in the US instead of Europe. Because they mention the process is too burdensome and too costly. As a result, many are discouraged to take advantage of it and to going public in Europe. Also, when they get listed, we see that they complain about the excessive regulatory red tape, such as excessive red tape for accessing capital. So the question that we will be asking today is the Listing Act and the changes it introduces is really a game changer for the EU capital markets, or is it just a very modest step forward, a sufficient one, but a necessary one, but still insufficient in a longer journey? There's a key question we'll be exploring today with our three speakers. To guide us through this topic, I'm pleased to welcome three outstanding speakers for this topic. The first speaker that we will welcome is Menno Bax. Maybe you can put the slide on. Yeah, Menno Bax. So Menno Bax is going to be the one introducing the regulatory change outlook. Menno Bax is attorney at law and partner at Loyen & Loeff. He will guide us through the key regulatory changes with a clear and comprehensive snapshot. The second speaker of today will be Michael van der Hove, CFO of Warehouses Depot, better known under the acronym WDP, a prominent Belgium market leader in Benelux and Romania in logistics, Belgium index constituent in the BEL 20. It will offer us company-level insight and also real-world impact of the reforms, but also pointing out already the potential improvement that we can see in the European capital markets. And finally, the third speaker of today will be Rogier Quirains, the head of Europe Real Estate and senior portfolio manager at Cohen & Steers. He also oversees the research and analysis team for European real estate securities. And Rogier will give us an investor view on the state of European real estate, listed real estate, and how the Listing Act might or might not shift sentiment. With these three top-tier voices, we hope to provide you today a comprehensive understanding of where we stand today, but also where the challenges are, so we can already think ahead. Just as a matter of structure, each speaker, we will do it through a fireside chat for making it more interactive. We'll have around 10 to 12 minutes for each part, leaving us around 5 minutes for a Q&A session if any questions comes up. Maybe let's begin with you, Menno. Menno, to set the scene, I will have more of an introduction and general question. Is the EU Listing Act a true game changer, or do you see it more as a very modest step forward for the EU capital markets?
Yeah, thank you, Jonathan. And first of all, good morning to all, and thanks for the invitation. That is quite a question, of course, and I think to call the EU Listing Act a true game changer, in my personal view, is way too far, way too strong an attribute. It certainly helps in facilitating the access to the capital markets, and we'll get to that. But I still would not call it a game changer, because I think it only addresses one element of the overarching sort of ambition of the EU to come to a capital markets union. It's an important part for sure, but in that it is too narrow in its scope to be a true game changer, if you ask me.
Okay, then maybe let's dive a bit deeper into it, if you don't mind. Could you maybe give us a snapshot of the key changes the EU Listing Act introduces and why this is important for listed companies, but of course also for listed property companies?
Yes, for sure. I think it's important to indeed understand that the background to the listing agent is very much driven by what you mentioned. It's too burdensome to basically, from a legal perspective, access the capital markets. Not only when you do the IPO, but in particular also for follow-on transactions. And I think that's where the simplification that the Listing Act brings can be very helpful. And so there's an extension of exemptions that companies can benefit from once they are listed. And so your initial listing, I think there are limited simplifications in that respect. One that maybe stands out is the reduction of the historical financials that you need to include. Currently, it's 3 years look back. That is going to be 2 years, and that can be very helpful. At the same time, it really depends on the type of offering you do, because it's one thing that we, from an EU perspective, allow only 2 years financials instead of 3. But what if, for example, you also want to access certain US investors and need to rely on 144A exemption? Then you already get the overlay from the American rules, and you may actually still end up with a 3-year look back period. Another question is, if, even though allowed, in marketing in particular your IPO, will the banks actually find 2 years historical financial sufficient enough? Is it really allowing people to make a true comparison? So in a way, it's good that from a technical perspective, you can do with only 2-year historical financials, but I think the real proof will be what will the market still expect. But it's at least a simplification. Another important element is a more uniform approach towards a prospectus. Currently, we see the prospectus regulation. It's a regulation, so it's applicable in all EU member states, but still how people in practice approach a prospectus, and in particular driven by the relevant authority, you see quite a difference between even the format of prospectuses, and that doesn't help in comparing the one IPO with the other, or the one prospectus with the other. So now we're going to a uniform template, and the idea is really that will enable the comparison between listed companies. But the real sort of change and the simplification lies with any follow-on transactions. So once you are listed and you want to do an additional capital raise, there's one additional exemption that really stands out in my mind, is that now you actually have the exemption to offer new securities to investors, and that includes retail investors, and that may actually be relevant in particular for property companies. And to also make use of the 30% exemption, and even if you're listed for 18 months, then there's no limit in the percentage. And we used to have that exemption only for the listing prospectus. It used to be 20%. That is now being increased to 30%. But that exemption for also the offer to the public is a real nice addition, I would say, that will facilitate follow-on transactions. And then in particular, once you're listed for 18 months, then you basically don't need a prospectus anymore. what you will need is a very short form exemption document, an Annex 9 document. That's something that we'll see more often, after the first half of next year, because that's when the more substantive format changes to the prospectus regulation will come into effect as of June next year. The extension and expansion of the exemptions is already applicable at the moment. I think those are really the main changes when it comes to the prospectus regulation. There are also a little bit of simplifications under the market abuse regulation in terms of ongoing reporting, in particular when it comes to the disclosure of so-called inside information in the context of ongoing negotiations. If you ask me, at least for coming from the Dutch practice, it may actually be a little bit of a encoding of what is already practice or accepted market practice, but it's helpful to have a more explicit guidance that once you're in negotiations and there's a development that in itself amounts to inside information, you may delay the disclosure of that inside information once your negotiations really have been completed. So in a way, it does bring simplification that can be quite helpful in practice.
Okay, thanks a lot, Menno. Actually, you already replied to the second question I had, so I would like to take you maybe somewhere else and to address a specific point regarding the efficient and direct capital placement, such as the ABBs, the accelerated book building. In many member states, including Belgium and the Netherlands, and probably other member states, we see that despite the regulation, despite the EU Listing Act, that market norms and internal national limits, national corporate laws, often restrict the issuances under such a direct placement. So how do you assess the new EU Listing Act, the new prospectus regulation exemption extension, and those limitations that you see, like for example, about 10%, I think is the case, the same in the Netherlands, the same in Belgium, on such a direct placement such as the ABBs?
Yeah, exactly. And that's a very good point. And I think that's where, when I mentioned the Listing Act only tackles one element of the access to, or simplifying the access to capital markets, I think this is exactly another constraint, really, that is not imposed by the prospectus regulation or securities laws, but it's corporate law. And in fact, actually also very much driven by the voting guidance by proxy advisors, such as Glass Lewis and ISS, where indeed the authorization to issue new shares, which in principle is a shareholder resolution, but in many jurisdictions that authority can be delegated to the management board in order to allow flexibility. You don't need to dress up a full-fledged general meeting of shareholders if you want to do a new issuance of shares, but that delegation of the authorization is often indeed capped at 10%. Sometimes even the cap is encoded in law, which I understand is the case for Belgian REITs. But it's more generally, it's driven by those voting guidelines from the proxy advisors and thereby basically an international market practice. So in order to really make use of the simplification and the more flexibility under the Listing Act to go to 30% or even beyond that, it would be helpful for the market, I would say, to at least loosen the authorization limitations. At the same time, there is merit in having that limitation, right? Because we're talking about dilution. So it's always the combination of issuing new shares, but also excluding the preemptive rights that your existing shareholders have. And I think that's where it would be interesting to see how the market is going to go about the additional flexibility under the prospectus rules. Are there allowing more flexibility, more from a corporate law perspective.
Okay, thanks a lot for this very detailed point. And I think we will also be talking about this point with Michael just after. But for having a key takeaway from your side in 1 minute, could you tell us from a regulatory point of view, because you're here as a regulatory expert, what would be the remaining regulatory bottleneck that really have to be addressed for EU listed companies from fully accessing the equity market? If you can summarize.
Yeah, no, I think ultimately, and it's a topic that came up during another seminar as recent as last week. It's about liquidity, really facilitating liquidity. And I'm sure that Mikael and Rogier will also address it. But loosening or creating more flexibility under other European rules, and in particular MiFID II, to allow basically more flexibility for research analysts and to publish research, to cover listed companies, and to really sort of drive that liquidity. I think that is really something that's missing from a regulatory perspective.
Yeah, thank you very much. And actually, we will also cover this point with Rogier during the third part. But now switching, thank you again, Menno. Shifting a bit of perspectives, and I would like to hear from a market practitioners. Michael, turning to you again to start with a general question. What's your take, and how do you view the changes introduced by the EU Listing Act from WDP as a listed real estate company side?
Well, since we are capital-intensive companies wanting to grow as well, capital is our raw material. So I would say any incremental change in raising capital more flexibly is a win. But that said, the EU Listing Act is, for us, in our perspective, an evolution in the right direction, but not a revolution. And I fully follow Menno's comment that it's part of a bigger picture with parallel initiatives that should be taken to make us as Europe competitive with other parts of the world.
Thank you. Actually, I had a chance to listen to you a couple of times in the last few months, and I found some of your comments very interesting. And actually, I wanted to address those comments that you made here today. So I have a couple of follow-up questions for you. The first one is that a bit general as well. Over the last, let's say, 15 years, we have seen a low equity to debt issuance in European REIT sector. What are the reasons in your view, and is the Listing Act capable of changing that?
Well, I think there are several reasons for the relatively low equity to debt ratio historically. First one is a purely technical reason, of course, since equity capital is permanent and debt isn't. So debt has to be renewed frequently. Second point is, yes, the ratio has been historically a bit too low, albeit that it has improved after GFC, of course, as historically EU REITs have more relied on retained earnings and debt in the past, and capital raises are sometimes too concentrated on big events. And that is simply because raising equity in Europe is a more formal process with longer lead times and with regulatory hurdles. And as a third point, I would also cite that in our humble opinion, there is historically been a bit too much focus on NAV and less on cash flows, which are, in our view, what matters most. And sometimes we see the sector as being, in Europe, then listed real estate in Europe as being a bit paralyzed by NAV, which is one specific metric and not the sole metric to manage a REIT, as we think we are companies and not funds. And I think, last point, if we want to create large, liquid, profitable players in the listed real estate space in Europe, we need to give those companies the right tools. And that is, amongst others, of course, an attractive and competitive cost of equity through more flexible capital raising tools, such as through the EU Listing Act. Because do not forget, we raise public money, but we compete every day in the direct property market.
Yeah, indeed. And maybe a more practical question, because Menno mentioned the prospectus regulation changes, the fact that the threshold was increased from 20% to 30%. We know and we heard that issuing a prospectus is very costly. It takes time, money, legal, and also very much time. Could you tell us more or less the cost average of how much a prospectus costs, how much of a burden it is, and also how the EU Listing Act might change this in a meaningful and reduce the financial friction that you can have?
Oh, well, I think for a listed company and being a frequent issuer, rules will definitely be more flexible through the Listing Act, and that's for sure. And it will not be the big cost anymore. It's more, let's say, that managing the timing and the lead time. That's important to have an efficient process. We are seeing that things are starting to move in that respect, but everybody, and by everybody I mean companies, banks, regulators, lawyers, need to be more pragmatic to make it happen. So that is going in the right direction, I would say. For an IPO, I don't think it's the case yet. That seems to us still as a very burdensome and a very, very costly process to list a new company on the exchange.
So not a true game changer in this regard, as Menno mentioned. Something also we just touched upon with Menno is I would like to hear your thought on the ABB related issues, limitation threshold for Belgium REITs. Do you believe that EU Listing Act and all the noises that we hear around the capital markets can serve as a leverage to move things internally forward and to maybe see those limits a bit increased in the future?
Yes, that's a very valid point, of course, in the current context. And I would first say on the Belgian REIT regime, we believe it is really an exemplary and very successful regime with 15 companies being successful in their niche. But of course, improvements could always be welcomed as we need to stay competitive and efficient on a European scale. And in that respect, yes, I confirm that the limitation for Belgian REITs to only be able to execute ABBs for maximum 10% within a trailing 12-month period is a bottleneck and could be improved. And I think you hinted up in your question already. Yes, we believe there is certainly now that the Listing Act is more flexible, allowing up to 30% prospectus exempt issuance, that there is certainly an argument to do so. Of course, that is one regulatory, legal point, but of course it always depends, on the other hand, also on the condition for the board to having received the sufficient mandate for authorized capital from the shareholders. And we think there is a momentum to also enlarge those mandates. But now I'm speaking, of course, under the control of the investors.
Okay. Well, linked to that, actually, I have two questions. And one is based on one of your quotes. You have said, rights issues are sometimes unavoidable when you're a very small player, but from a certain scale onwards, they are value destructive. Can you elaborate on that? And can you maybe also talk in this regard about proxy advisors and what can also maybe be done from a regulatory context to improve as well this matter?
Oh yeah, indeed, we are absolutely convinced that apart from specific situations, of course, like a company not having yet reached the required scale, or for example, in the situation of large needs or transformational deals, that apart from those situations, rights issues are value destructive. And I will try to explain you why and our reasoning, because people always argue that in raising capital, when you have a rights issue, the company raises equity at a discount and that value is transferred to the investors in the form of a right. So it should be neutral. But consider then the following three factors, especially in a context where you're active as a company in a capital intense sector and you really need add-on equity on a regular basis. First of all, there is most of the time erosion in the value of the right. And secondly, you can perfectly have two similar companies, exactly the same, except for one thing, the one growing through rights issues and the one growing through ABBs, and yet both having the same EPRA earnings per share. The first needs 5 billion of capital to get there, the other one 4 billion. So that's not, in our view, an economic logic. And last, we think that management teams are responsible for optimizing the cost of capital and therefore need to create the best conditions to raise equity, as we see ourselves as responsible to create value on a per share basis in EPS and NAV per share. So what is the value then of having the right to participate if your EPS growth is much lower? And as a final note to the element of the technique of a rights issue, it's in an ideal situation, yes, we would like to give all our shareholders the right to participate in any liquidity event. If, for example, now I'm speaking blue sky, if the markets and digital infrastructure were available to, for example, have everybody participate overnight in a net market placement, but because it's not about the right, giving the right, it's about the open period at risk, which is a killer in rights issues, rendering it extremely costly. And then in your second part of the questions on the role of proxy advisors, we think that I already hinted upon this with these changes through the Listing Act and investors wanting to see low leverage in general, more liquid companies, growing earnings per share. Think that can only be achieved by also enlarging the envelopes granted to the board in terms of authorized capital. Most proxy advisors now advise for 10% maximum for the bucket, combining accelerated book build offerings and contributions in kind. I am launching the idea, why not increase that to 30% in line with the Listing Act with prospectus exempt issuances, but I'm also looking forward to Rohir's view on that, as ultimately investors should make that call, and perhaps if they would agree on that, exercise some influence with the proxy voters.
Okay, but yeah, indeed, we will address this with Roger in a minute. But before moving and turning to Roger, I would like to ask you, also like I did with Menno, something to end your intervention. How does the EU framework for you now compare to the US one in terms of capital raising flexibility? And how do you see again how the EU capital markets can move forward again to be closer and more competitive as the US market?
Well, when we look at the US has first and foremost a deep, liquid, and also centralized capital market, whereas in Europe there is a lot of fragmentation with around 40 exchanges. So it's like Manu already alluded to that. Yeah, it's also about having that unified capital market. The Listing Act is one part of the plan, of the bigger game plan. Second, US REITs raise more equity and more frequently and through at the market raises as a sort of, I would say, continuum to which investors are accustomed, and also with less speculation than as is often the case in Europe. I think it would benefit EU REITs if they would have a sort of more permanent access to new equity in a way that is acceptable in terms of dilution and for the investors, but which is also the least disruptive to the share price and can then also be used in a more proactive way rather than a reactive way, because REITs are a fantastic product for both the economy, also a great savings product, but are massively underutilized. So I think here there is a strong opportunity to make our sector more relevant and competitive on a global scale, and also broaden the access, for example, through retail investors, which is a point also often overlooked, I think.
Absolutely. And maybe also the ongoing thing happening at the EU level for the Savings Investment Union can also maybe help in this regard for the retail investors. Thanks a lot, Michael, for your very clear insight from the company perspective. Actually, not turning to you, Rohir. I'm gonna say Roger, if you don't mind, because I always struggle all the time. Okay, good. Turning to you as from the investor perspective, again here to start with a general question. What changes do you welcome? I know that you were quite vocal on that, but what changes do you welcome in the EU Listing Act?
Yeah, I think, well, very much in line with Michael. It's an evolution and it's not a revolution. What we certainly like is the fact that you don't need a prospectus for an ABB. So we're very much, in favor of ABBs versus rights issues. So I think that's a good step from that perspective. So yes, access to capital, flexibility, that's very important for us.
Okay. Then maybe after the positive side, I will turn to the negative side. How would you compare, same question than before, from your perspective, the functionality of the equity capital markets in Europe versus the US, particularly in terms of capital accessibility for listed property companies and for REITs?
Yes, we've spoken before. I think in Europe, there's more the preemptive rights issues, and I think that sets Europe a bit back versus the US. You don't have that in the US. US REITs can come to the market, open the book, close the book, and they can do that in a day. And in Europe, it's more difficult. You do have the ABBs, but they are limited, and they are, like we said, still limited from a legal perspective, despite maybe now with this new act, you can do 30%, but then locally they would limit you maybe still to 10%. So I think, that still could hold Europe back from that perspective. But I think also, and we talked a bit about the proxy voters. Yes, I think there's still very much the idea in Europe that you have to protect the shareholders, which I think is not really the right starting point. We as a shareholder, I think, should do the work that we say, hey, this is a good company. We want to give them equity because we know the management and the board understand what they do. They create shareholder value. So yes, let us be flexible about that and let those companies grow in the best way possible. There's obviously different companies that are less successful, but I think let the capital market do that. And I think that's always in Europe. They try to regulate everything, but if you don't regulate it, the capital market can regulate it by itself. So, a company, and that's what you see a bit in our industry, is a company that is protected actually by the regulation often misuses that protection by not creating shareholder value, but by kind of destroying shareholder value. And I think that's a bit where we as a US firm also come from is if you deregulate, let the market regulate it, and the good companies can grow faster, and the companies that are not well structured, don't have the right corporate governance, will disappear. And I think you see that happening a little bit actually today in the UK, where we have better companies now than we had, let's say, 15 years ago. Lower leverage, more focus on FFO, less focus on NAV. And they are in the market now taking out the companies that are having bad corporate governance, externally managed companies, very NAV focused. So yes, I think if you look at the UK over what's happening at this moment, you can see, hey, the capital market is working. It is working. So I think that makes me positive. It's a little bit less linked to this directly to this issue what we talk about, but I think it does show that if you let the capital market do its own work, it works. So we need less regulation still, I would say, going forward from that perspective.
Yeah, and I think that it's one of my questions toward the end is that we will see it with the example of MiFID II and the unbundling rules, that this regulation back in, this regulatory shift back in 2018 didn't do any help. And now it changed again back to the situation back in 2018. It's a good example of what you just mentioned about over-regulation. But before that, I also wanted to address with you the rights issue. I quoted here that you were quite vocal on the elimination of those
Yeah.
rights issues. So should we rethink the way they are used, eliminate them, and how does it currently affect the listed company sector?
Yes, well, ideally you would eliminate them, I would say, if you just look at the US and Europe, because it makes you more flexible to grow. And again, I think, you know, shareholders should have trust in those companies that raise capital. You can only raise capital once, maybe, if you don't do it correct. So I think, secondly, there's a regulation around it. And I would say, yes, if you are, you know, within that rights issue framework, I think there's a lot possible. So we also say, hey, if you are or want to act within the rights issue framework, do it more flexible. And I think we've seen a couple of those things. We have initiated some of those things ourselves also. So it's very important to make the distinction between a offensive capital raise and a defensive capital raise. So in the past, we've seen a couple of defensive capital raises. That means, hey, you know, you're kind of forced to participate. Then you're forced to do a deeply discounted rights issue. So I think, you know, that's you save the company, and that's a special one. But looking at growth of the sector, and that's ultimately what we're talking about, is that investors like us get wall crossed, so we can look at the deal. We give our view, so the banks wall cross us. Let's say they wall cross 10 investors. Let's say 10 investors say, hey, this is a great deal. You know, we're here, we support it. At that moment, and I think that's still where things kind of go wrong, you would like to see a rights issue then, if it's a rights issue, at a lower discount, or actually at market. And you obviously then get the excuse, yes, but you don't know, you know, it's going to cost time. And who's going to take the risk? Well, that's where we are. We say, we're here, we like the deal, there's the money, you know, and then they say, yeah, what if there's a whatever, a nuclear bomb going off, those kind of excuses. Well, you can even say then, you know, no deal is fine. But, you know, what I want to say is there's no creativity. And I think the rights issues are probably the best for the banks that initiate them. And this is where I would like the companies and the banks, you know, have a better debate. Why not lowering the discount? Because like Michael said, the discount is actually something, you know, it's a cigar from your own box. And it's not, it's not good for the company. It's not good for the cost of capital of the company. So if you lower that discount in an offensive rights issue, it will already be a good step forward. And we've done that. We've done an at market rights issue actually. And that was pretty successful. But you need the company, you need the banks, and obviously the banks are not really fond of it, because if you are the bank, the deeper the discount, the lower the risk, and they take high fees. So, you know, it's in their incentive to keep with the status quo, which is kind of in the UK a 20% discount to TERP. That's kind of what they say is market practice. But yeah, we'll need management teams, boards that say, okay, let's do it different. And I think Belgium is a pretty good example where the companies have been able to lower their discount to TERP. And also, make the difference between offensive and defensive rights issues. And then there's different deals still possible. You can an open offer clawback. I think that's something that has been introduced also in the UK more than on the continent. So slowly we're getting there, but I think, we'll need much more support from banks, management teams, boards, to, if you do a rights issue, do it different. Obviously, ideally the ABBs. I think Michael made a perfect comment around this. This is the best structure for us. So I think overall, ABB, if you do a rights issue, make it a lower discount if it's offensive, or make it a bit more creative. But then I think what is still difficult, and for us, we have been in contact with those proxy voters and to bring this message, and that's very difficult, if not, yeah, I think impossible for us to convince them more. Hey, look at your shareholders and don't make it a defensive one. Make it more like, yeah, offensive in the sense, see the opportunities, raise capital, and grow. And indeed, if a management team is not the correct management team, yeah, they can hide behind those regulations, and that's the problem in the sector, I would say.
Thank you for this summary at the end, and I would actually make sure to circulate this in a very interesting way for audience. But as we have a couple of questions left, and I see already two questions from the audience, I would like to move a bit to the next question, Roger. Is for you the Listing Act likely to make public listings more attractive from an investor point of view? Or do you believe that there are deeper market structures still in place, such as fragmentation of markets, about short-termism, volatility in public market, cost of complexity, or what's your take on that?
I think if I look at European REITs, it's obviously not going to make a huge difference. I think going forward on the IPOs. I think for us, it's at this moment more the volatility. I think you want a bit of reduced volatility, but like I said, this year we do see some M&A happening, which is positive. We see the good companies taking over the bad companies, and actually putting the private equity a little bit on the backbone. So I think that's a positive one. I think the fragmentation is definitely something that is inefficient. So I think in Europe lately the differences between the countries are getting more, yeah, bigger, call it like that, because of the different balance sheets of the countries, the geopolitical risks, the interest rates. So I think that's where, yeah, ideally you would have more integration in Europe, euro bonds, those kind of things. But you know, we're still Europe, we're still, you know, have Switzerland, we got Sweden, we got the UK. So I think, you know, that doesn't go away. So yes, then the question is, can some of those companies that are in the better countries benefit and grow into the rest of Europe? I think that's a fair question. We see that happening a little bit in Sweden. Some companies that benefit of cost of capital advantage growing in the Benelux. So yes, I think it has its disadvantages, but also its advantages ultimately. But then it's up to the companies if they, yeah, make use of those advantages, call it like that.
Okay, thanks a lot. If you will allow me, I would ask you for, before moving, because we have two questions from the audience, the question of the MiFID II unbundling rules. As mentioned before, in 2018, the EU Commission changed those rules to separate the cost, investment research from the execution services cost. They changed their mind because they saw that there were less research and analysts on small and mid-cap companies.
Mm-hmm.
Do you believe that this reversal of MiFID II rules might have increase of analyst coverage, but also capital inflows into small and mid-listed property companies? Or do you think it's too late already?
It's never too late. It's push and pull. So I think, yes, it will help. So it will get some companies, yeah, to a broader audience. So I think that helps. But it's also, yes, we as a sector should offer something very good to invest in, call it like that. And I think if you look at the last 10 years, European REITs have improved, but they can still improve. So I think, again, look at what's happening in the UK now. I think that's an example where you see the smaller companies that are a bit more owned by the retail investors and that were poorly structured are now being taken over by the better companies. The retail investors will go into those companies because share for share deals. So I think that hopefully brings this sector a little bit more into into the retail investor space, call it like that. So we get more retail money, and then this is more UK driven, but we get more and better access to the retail money in the UK. So I think that will be good. Yes, that's what we need. I think in Belgium, it's actually retail money has always been there. So I think it's good. But the rest of Europe, we definitely need more retail money. So yes, coming back to your question, more analyst coverage can help with that.
Okay, good. Thanks a lot for that. Two quick questions from our audience. Can I ask you, whoever feel comfortable with answering, a maximum 30 seconds because we are already running out of time. But I have two interesting questions here. The first one from Charles. Do you think we are approaching a tipping point where private capital's dominance in real estate might begin to shift back toward public equity?
I just said that it's happening as we speak
Mhm.
in the UK. So we see the private equity actually losing out some bits now. So I think that's good. I think if you look at many private equity funds now that can't exit, and there's, the listed market has dealt with the problems of higher interest rates probably for 80% or so now. I would argue the private market has not dealt with that. So it's very much extending and pretending in the private fund market. So once the listed market has its cost of capital, and some have it, yes, they can probably take over or create some exits for those listed players, and buy some stuff. Will they IPO? That's a good question. I doubt if the valuations that they have today will be the ones the market wants to pay for. So it's like, do they still need to write down the valuations and make it more attractive for IPOs? I think that's a fair question. I think if you look at the open-end funds, the problems in the open-end funds that we've seen coming, and actually we've seen that happening now in the UK maybe twice or three times. So sometimes you ask, how many times do people have to bump their head before they finally go to REITs? But I think it's happening, but it's happening slowly.
Okay.
It's happening slowly.
Menno, Mikael, something to add on that?
Fully agreed.
Fully agreed.
Yeah, same.
Okay, and then let me maybe finish because I think people would like to go for lunchtime. Last question again, if you have a comment on that, 30 seconds would be amazing. Are you aware, this is from our CEO, are you aware of any country contemplating to revisit its rate regime and to make access to capital easier? Example, by increasing ABB threshold or improving timeline. So we have already discussed a bit, but maybe if somebody wants to take this one, maybe Mick.
Oh yeah, it's a relevant question, and I will answer on behalf of the Belgian REIT Association. And I think it's like I mentioned when we touched upon this topic that with the flexibility that is now integrated through the Listing Act, there is at least a momentum to address this with the regulators and the legislator to ask for more flexibility. Yeah.
Okay. Thanks a lot. Somebody else, Menno or Roger?
Yeah, maybe at least from a Dutch perspective. But I think the Dutch approach is more aimed at loosening the tax regime and making that more attractive. I'm not aware of any changes from a more corporate law perspective.
I'm not aware, but I think what we've said, ideally you would have a European REIT, obviously, but I think that's still far away.
Yeah.
Because the Netherlands went backwards, but I think they stopped that. But
Okay. Well, thanks a lot for all this information. I will make sure, as I said, to compile those information in a summary document I will circulate, because a lot of things have been said today, a lot of interesting also things regarding the challenges ahead of us. So thanks a lot for the three of you. It was very interesting and a very interesting conversation. Yeah, wish you a very good end of afternoon, and talk to you very soon then.
Thank you very much.
Thank
Thank
you.
you.